Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Offices would say Monday, but I've been around the block a few times. So this is, in fact, Tuesday, September 3rd. That's letter U for you futures junkies out there. Of course, October's letter V, and I'll explain at a different show as to why they write letter V upside down like TP. This is Market Call. It is Dan Nathan's guy, Adami. It's 1 o'clock on the East Coast. Carter Worth of Worth Charting will be joining us shortly. Dan, how are you?
I'm doing great, guy. I mean, today feels like kind of the way we started August. We're kind of starting September a little bit. We have an S&P futures down about 1.5%, NASDAQ futures down 2.5%. And guy, you got to give me a reason why this is happening, because usually on Market Call we say, why is the market up? And what's your answer?
Because typically the answer is because it's open. And the fact it is open today, so that's obviously not the answer for this downdraft. But if you're asking me to pontificate quickly, I will take a stab at it. I think Friday's late day action was absurd. If you watched, which obviously many people did, that melt up late in the day on the back of month end was ridiculous. So I think that was, part of it is working off that, number one. Number two, and we'll talk about this, I think this dollar yen trade is far from over, and you're seeing dollar weakness, yen strength, which leads to that. Some of these manufacturing data we've seen have been indicative of a more severe slowdown than I think the market realizes. You've been bringing up China correctly for months now. Their data continues to suck. And I think it's just sort of some amalgam of that.
Yeah, and it's interesting because you mentioned the ISM data, continues to show that we're in contraction, right? But there seems to be sort of two narratives in the economy, if you will, is that the, consumer, at least on the mid to high end, continues to hold up, right? And the low end, I know that we talked about it late last week, what's going on in Dollar Gen and some of these other names. Walmart seems to be taking share from up above and down below, which is an interesting Walmart sort of thing. It's an interesting Costco sort of thing, but we've definitely had a mixed narrative, I'd say, from some of the retailers that we saw. I do think that global growth, and we're going to talk about it a little later, seems to be one of the sort of monkey wrenches right now today in what's going on in the markets, and we'll get to that in a little bit. But guy, let's pull up the S&P futures chart here, the E-minis.
Well, before we even do that, I mean, because people want to know what we're going to talk about. Amanda did such a great job. Let's throw the rundown up.
Oh, yeah. Let's do it.
September swoon coming. And by the way, Tom Lee, who I think we have asked to be on our podcast, he was on, I believe, the Squawk Box this morning, and he talked about, I don't want to say a certainty, but he was saying like he had some degree of confidence that a 5% pullback was, sort of coming, and maybe potentially 7 to 10. So I think, that's interesting on the back of maybe some seasonality. Sector chart check with Carter. That's not easy to say. Semis get smoked. I like that. And a trade idea in JPMorgan, Dan, that you've come up with.
Yeah, so we're going to hit all of those things. Excited to hear what Carter has to say on the sector front. I know he's coming with a lot of charts here. Before we get to him really quickly, though, I jumped the gun there. Let's do the S&P 500, the E-minis here. We didn't really even have to draw any lines. We'll leave that to Carter to do. One of the things I think is interesting is that we never made a new high, despite the ferocity in which we had that V reversal off those August 5th lows. And you see this sort of, we have this little consolidation here over the last 2 weeks or so. You see that rising 150-day moving average. It continues to rise. I don't think it's done anything else other than the last 18 months or so. So thoughts here, Guy, about the inability to make a new high, the consolidation, and if we were to break below this consolidation, is the 150-day in your sights?
Yeah, so all fair. So we've, as new viewers or old viewers that have not been paying attention will see, we have now gone from the 200-day moving average to the 150 because we've listened to your comments as well as Carter's. And apparently, if you go back and look, it actually works a lot better for the work that we're trying to do. So you can see the downdraft we've had, obviously, in the fall of last year and what we saw on August 5th. That was short-lived. I will say this. As good as that bounce felt if you were long stocks and as much of a relief that it was, this is just my opinion. I think it's probably in retrospect can be the worst thing can happen because it happened very quickly and it seemingly exhausted itself, as opposed to what we saw in March, April into the summer, where it was just sort of this slow, steady grind back to a new high. This obviously took place in much shorter fashion. So what I think is going to happen here is we will go back and take a look at the 150-day, which will probably come in around 5,300 and change or so. And you correctly mentioned that the moving averages have been lower left, upper right. But if you get a couple of days, weeks, whatever, of sideways to lower action, you can start to see, excuse me, how that 150-day is going to flatten out and potentially turn lower. So all things that I'm watching very closely over the next few weeks.
Right. And so more interesting to me than the S&P 500 is the NASDAQ 100 E-minis here. And when we think about the S&P was within 1% or so of those prior highs from, late July or so, I look at the E-minis here, the NASDAQ 100, and I say to myself, if they could pull that up, is that after that August 5th low, the move that it got when it topped out, guy, was still 5% among, below those July highs. And here we are now, we're down about 8.5% or so from those July highs. We know why. The concentration in the NASDAQ 100 versus the S&P, where, those top 10 names are about 50% of the weight of the NASDAQ 100, and they're only about 30% of the weight of the S&P 500. So we're going to get to semis here, but semis are leading to the downside, and they're obviously weighing on the NASDAQ 100.
Which makes sense. And, again, people will say at times correctly, but I think in general that, Guy, you're a hater in terms of, NVIDIA and some of these other high flyers. I'm not a hater at all. But what I'll tell you is, and, obviously you just mentioned semis, and a big part of that is what's going on in NVIDIA. Quickly throw up an NVIDIA chart. I mean, when they reported earnings, Dan, I think the stock closed around 125 and change or so that day. Don't at me if I'm off by a buck, but I think I'm pretty close. And what we said on that day is, despite the magnitude of the EPS beat and the guides, and actually Gene Munster actually addressed what I said during his commentary. The magnitude in terms of percentage of the guides are quarter over quarter starting to go lower and lower. It's not an indictment, it's just fact. And that's quite frankly what typically happens. And my concern has been, as the market starts to see what's happening there in terms of the guide, it's going to be very hard for them to justify the price to revenue that this stock trades at. And in small part, I think that's what you're seeing over the last few days.
Right. And so the point that Gene was making is that, their guide on a sequential basis was up, 2%, and that's above the whisper too. And, there's something to be said. A lot of like massive bulls in the name are going to say, well, they pushed out Blackwell by a few months, that sort of thing. So the next iteration of this Hopper chip, to me, that could turn into misexecution. It could, turn into kind of guidance that is below expectations and the street guiding down, or taking down their numbers. So again, we'll hit the semis in a few minutes here, but let's bring Carter Braxton.
Bring him in. Bring him in.
Want to get Carter? There you are. Thanks for joining.
Hi, guys. Yeah, hi.
Before we get to the sectors and the work that you're doing, just thoughts in general about some of the things that we just said about the S&P futures and the NASDAQ futures, and how much the NASDAQ is below those prior highs on a relative basis. Is that important to you one way or another? And when you think about leadership, I guess, in the market.
Yeah, I mean, there's so much going on. I think the temptation always is to have a reason, right? I mean, I think if you truly are a journalist and the editor says you've got to write a column right now, midday, about the market, you can't just say the market's down, sign your name, market's up. So the human condition is to find a reason. And one can say, well, Goldman downgraded copper and all the CTAs or something. There's always, but sometimes that might look like the reason, but it's not. But what we know is, and this is most important, we're not really in the why business, right? We're in the what business. And what we know is market is down. And the market, after ricocheting, was unable to make a new high. And interestingly, of course, the equal weight S&P was. And so we're getting more of the unwind of the concentration or the money in so few names. And as that money comes out, the bull or the hopeful person would make the case, well, if it comes out of the high flyers, the concentration in those great marquee names, household names, then the money will flow into the others and then the market will be okay. But there's just so much money in the others, and not all selling that's done immediately goes into something else. Some people just go to the sidelines. There's always cash And so the net effect is the market is lower. And the question is this the beginning of a more important topping process? So we have a great run up. Everybody knows that from the October low. We have an impressive sell-off. Just to put it in context, the S&P drops 10%. It's actually 9.7, but let's round to 10. The most important sector within the market drops 20. That same sell-off from July to August 5th low. The most important area within the most important sector, semis, drop 30, and the most important stock within semis drops 35. S&P down 10, biggest sector down 20, semis within the biggest sector down 30, and NVIDIA down 35. And so one could say, beautiful, it's all had its correction, massive correction, and we can go on and make new highs. That would be one view, and that's certainly possible, but that's the bull view. The other is that's a harbinger, right? A foreshadowing of more distribution of a topping process. My bias is that the latter, we shall see.
All right. So we have, Amanda did a great job with this sort of graph as to sectors and their performance. So before we get to your charts, let's just take a look, because obviously, as we just addressed, the XLK underperforming. You can see what it's done year to date. Energy not far behind with a, an index, or I guess a sector that's not done particularly well this year. And then so on down the line. Consumer staples, which I think is interesting today, Dan, outperforming. That to me reeks of being defensive. And obviously we're seeing utilities in the form of like a Con Edison, for example. I believe it made a new all-time high today. So again, something for everybody here, Dan, Nathan.
Yeah, it's interesting. And Carter, we talked about this a bit last week, that some of the defensive sectors were acting pretty well, especially as the S&P was approaching those prior all-time highs. Now you have a day with downward volatility that kind of reminds us of about a month ago or so for some very similar reasons. And then you have XLU and XLP acting pretty well, Carter. So walk us through what you're thinking as it relates to the sector performance. You can see that all of them are green year to date, but some of the ones that, at least that investors were a bit more worried about as it relates to the secular trade in Gen AI, but then also from a growth standpoint as it relates to, let's say, energy and materials, and the ones that are, kind of interest rate sensitive as it relates to, real estate and home builders and the like.
Well, that's the key, right? There's two main themes. It's interest rate sensitive areas of the market. Look at insurance stocks. They're literally through the roof. Property casualty, Allstate, Travelers, Chubb, that kind of thing. But it's rate sensitive names or it's defensive names, right? And that is the story of the year that was on paper so good. But here we are post Labor Day, and the reality is when you have a year where utilities are outperforming, and remember that's not adding in the dividend, right? A total return of utilities is even more wide over the total return of the S&P by virtue of the utilities having a bigger dividend than the market overall. Or one could say, well, what about telecommunications? But that's not the sector that it used to be, right? AT&T is having a nice year, but that sector, it's Meta and Google are almost 50%, and Meta's had a big year and so forth. But it is about generating at the institutional level, right? If one is a steward of capital, of other people's life savings, retirement, it's about beating the market through stock selection, or overweighting and underweighting areas of the market, sectors, themes that have the prospects, as judged by the manager, to outperform the overall S&P. But here we have it, and we shall see. Maybe we can look at the sector.
Well, let's take a look, because the keen eye will see that there are 11 sectors there, and you brought with you all 11, I believe, and their relative performance to the S&P. So let's walk through.
Yeah, we can just go right through one at a time. And the setup here is very simple, as seen in the legend. The top panel, and it'll repeat chart after chart, is the sector itself, in this case, technology. The bottom panel is whatever's on top, its relative performance to the S&P. And so the two things that jump out, of course, is how poor the relative performance is. Even as the S&P has bounced, the tech sector has bounced off its August 5th low, it's almost making new relative lows right now. So I would say if one has to just go with a blunt knife, a blunt object, a butter knife, buy, sell, or hold, or overweight, underweight, or equal weight, my hunch is to be underweight this area of the market.
Let's continue to walk through a gingerly stroll, as it were, because I think XLI is next, and that's industrials.
Right. So you've got the big rails, Union Pacific. You've got things like Caterpillar. You've got Ingersoll Rand, defense contractor, acting very, very well, the list goes on. But this is a telling thing too. We know that there's been outperformance since June, July, but it's been an underperformer for almost 2 years. And so one could say, well, how do you square that off? We know what it is. It itself is going up, but it's not going up as much as the market because the market has been so dominated by those tech names. The relative performance is such a big ricochet here. My hunch would be to equal weight this. One has to, again, put it
Yeah,
in.
it's interesting though, Carter. We're going to spend some time on energy in a little bit and materials. When you think about industrials, you say to yourself, okay, if the ISM is below 50 for multiple months, sooner or later industrials are going to kind of play to the downside. I look at that 150-day moving average down there at 123. I also see in the pace in which it sold off in early August, and I say to myself, 123 could easily be in the offings. And what I think is important here is talking about correlations a little bit. We talked about that in July. If there's a reason to sell the market, and there were plenty of reasons to sell the market July into early August, correlations go up, tremendously, right? And so that's just something that I feel like a lot of folks have not, had the opportunity to kind of focus on a little bit. Walk us through XLC. Okay, that's the communication services. So some of our favorite, kind of internet names are also in there, right? When we think about this one, it's not just telco as it relates to telco 25 years ago. It's broadened out a bit.
That's right. I mean, AT&T and Verizon were the big weights, and now T-Mobile, of course, but they're not, right? Meta, I think, and Google are combined almost 50%. This, too, is a testament to using the 150-day moving average, but also it's a remarkable thing when something is going up and yet it's not outperforming. It's a mind bend. You're like, what's wrong with that? I still am up. I made money. But it is about relative performance. And to use the most extreme example ever would be the dot-com era. We peaked in March of 2000. But if you're sitting there in August, right, of 1999, you're in the barbecue in the backyard and you say, gosh, guys, I'm up, ladies, gentlemen, friends, neighbors, I'm up, I'm up 17%. What? Dude, my portfolio is up 29. Oh, mine's up 40. Mine's up 17. Doesn't cut it. It's real money and you're up. But it's all about relative performance. So I can say, well, I don't care about my neighbors. But if one is a professional steward of capital, it is all about, have you outperformed your mandate? Your mandate is to beat others, to win the race. So here is a weird one, right? It's up, but it's not doing anything either, nor underperforming. It's just flat. Look at that relative line. And so I would say this is an equal weight for me as well.
Yeah. And then the next one's kind of interesting because again, XLY, this is consumer discretionary. We talked about staples a little bit, defensive for some reason on the way down and on the way up. But when I think about the weighting of this, and it's important to mention that, some of these ETFs, we talk about construction all the time. When we get to XLF, we'll have plenty to say about that, which we have in the past. But when I think about XLY, the two largest components here is Amazon at 21% and then Tesla at 16%. I don't know why Tesla seems to be so discretionary. Is that relative to, a Ford Focus or something like that? So again, walk us through this one, because I think this is a narrative, right? When a lot of people think about discretionary spending, it's, important relative to XLP and obviously the S&P.
Sure. I mean, the idea that autos are discretionary, you don't have to buy a car, right? Whereas staples, you have to buy your toothpaste, you have to get your groceries and so forth. Interesting, of course, in this sector, McDonald's is the fourth biggest weight, and that's about 5%. And people say, well, that's clearly discretionary. But in a way, it isn't. It's almost the world's cafeteria. It's the cheapest single meal you can get without having to get your sink and your oven and your dishwasher going. And so is that a staple? It's all very curious. And to make that point, Apple itself, for one tangent, has been in the growth and the value component of the S&P back and forth about 10 times each. Sometimes it's value, sometimes it's growth, and so forth. But either way, yes, Amazon, Dan, as you say, and Tesla are a huge weight. I think it's probably 35 or close, with Home Depot, McDonald's bringing up the rear. And here too, this is worse, right? This is maybe we could go back to XLC just quickly. XLC's uptrend much more robust and it's relative better. Now go to XLY. XLY is an uptrend, the upper panel, but it's massive underperformance. it's back to its December lows. And so one could say, yeah, but that's because Tesla's been a problem and Amazon and so forth. And McDonald's has had a problem, but it's bounced lately. But either way, if one is trying to play chess with the benchmark, and the benchmark is made up of 11 sectors, is this an overweight? I would say no way. I would be underweight.
Energy is interesting in the form of XLE. And what I find fascinating about this chart is, they've basically both been sort of flatlining to slightly lower, which makes sense if you think about how uninteresting they've been. Dan talked about construction. Basically, I want to say almost half this ETF is three of the names that everybody's heard of: Chevron, Conoco, and ExxonMobil. But speak to me about this, because if I were in your head right now, you'll probably say this looks like a pair of twos to you.
I think that's right. I mean, I think that's exactly right. So sometimes something is where it belongs. I mean, the temptation for all of us, I'll start with myself and not to speak for anyone else, but you see, well, this one is about to get better, or this one's about to get worse. Sometimes they're just where they belong. I have energy as an overweight, just officially, for what that is for institutional clients. But it's not doing anything, right? In fact, it is underperforming. But here too, what a curious thing, where the whole thing is 3.5% weight. It's the entire sector is 3.5% weight of the S&P, and two stocks are 50%. So is it a sector? Two stocks are 50% of a sector's weight, and the sector itself is only 3.5% of the entire shooting match. A huge part of the economy, a massive area of employment, energy and all its derivatives, but not an important part of the S&P 500. I have it as an overweight. Might have to revise that, but for now, sticking with it.
Yeah, I think the large integrateds probably, continue to underperform. If we see crude below 70, we're going to hit crude a little bit later. And I think about the OIH, so that's the oil services. And again, you have a situation where three stocks make up 40% of the weight of that index or that ETF that tracks that sector. Let's look at staples really quickly here, Carter. Just your take on whether this XLP, do we have in the cards possibly, long consolidation? You see this breakout. We talked about it being defensive since those July highs a little bit. Is this something that you would expect to kind of move back towards that rising 150, which is very near the breakout level?
Yeah, well, it's a curious. This one's interesting in the sense that to do all of that work, right? I mean, all of that work since the September low over the past year, really up and to the right, performing, producing, and yet not good enough. Its relative performance is straight down. It's a conundrum. You're like, but this is going up. It's good, but it's not good compared to other choices one could have made. The key is the relative performance bottoming? It is the beginning of a bearish to bullish reversal. Look, this is being driven by Walmart, which is at a very big movement, and Costco and others. Coke is making new highs, but this is not a growth area of the market. This is a very defensive, and these are full. I never use the word expensive or cheap because those words cannot be qualified, quantified, known. But to go that far over the past 12 months and all the while still to be in the back of the pack is pretty depressing. I have this as an underweight only because it's so steep and uncorrected. It's just where from here.
Here's one that I think is really interesting, are materials, which these charts, much like what we just looked at in the XLP, tell a much different story. I mean, if you look at the XLB by itself, you'd be like, to your earlier point, you know what? It's been pretty good since December. But then relative performance-wise, you can see, I mean, nowhere close as to what it should theoretically be.
Yeah, I mean, exactly. And this is a teeny area of the market. Again, I mean, you're talking about the smallest one at 2.25%. I just wouldn't do it. I would be underweight. It's highly cyclical. It's a beta trade. It's believing in sort of recovery in the global economy. It's a lot of China stuff. I would be underweight XLB materials.
Real quick. Oh, sorry, Dan. I was just going to say, everybody's darling, everybody's all-American comes in the form of XLV, and this is healthcare.
And here too, which is remarkable, it's very similar to staples. So the classic two defensive areas are the market are sort of healthcare, staples, utilities, of course, but that's a rate thing among other things. And it's almost identical in terms of what's going on a relative basis, a long and protracted decline, underperforming the market. And yet that's starting to turn just by virtue of it's going up as the market itself is stalling. I have this as a an overweight. I mean, sort of officially for institutional clients and so forth, and for trading subscribers. And I think what's interesting here is, as opposed to, let's say, staples, which are sort of monolithic, this has both offensive and defensive characteristics. So large pharma being defensive and other things, devices, but it also has the upside of the torque that's available through biotech. I like XLV long.
All right, let's skip ahead to the financials, XLF. And this is one, we've talked about, Carter, the makeup of this. And, it's not exactly banks. When you think of, Berkshire Hathaway is the largest holding at 13.5%, then it's obviously followed by JPMorgan and Visa. So it's just not, and then MasterCard, it's just not a great vehicle to trade the banks. But Berkshire, we've spent some time on over the last week. It seems to be very defensive too. You're seeing money go into that. You're seeing this cash pile of $270 billion being amassed here. Talk us through the XLF, because we're going to hit JPMorgan a bit later, but just interesting to get your take on this one.
Yeah, so there's some very reliable businesses in here. While they're not the biggest weightings, but you think of things like Progressive or Chubb. You have the more beta, Visa and MasterCard, independent of political risk, very stable businesses. And so it is the BKX is nowhere near this in terms of performance. The question is this. Is this something you trim? The relative is just so poor. My hunch is to be equal weight here, and then to be trimming some of the steep and incorrect names. I would point out that Berkshire's relative performance all-time peaked in late 08, early 09. So it has still never made a relative high to the market since then. That's a long time ago. And we know what that was. That was the end of the world, to the point where people went to Warren Buffett on their knees. Literally. I mean, that is like out of the movies, begging. And he meted out help and support where he deemed he could make a handsome buck, starting with Goldman Sachs. So his relative performance right now speaks for itself. Is it a cash holding? Is it Apple, which is defensive? He's reducing his Apple, or what is it? He's reducing his Bank of America. But either way, it's this is a bet the jockey, not this chart here, but Berkshire. People saying, look, we've seen this before. When things really get bad, this is the man among all men who seems to have the best chance of not blowing me up. But either way, I think equal weight to underweight, sort of in between for XLF.
As do you, Carter. You are the man that gets things done for us on a very consistent basis. And now those charts were fantastic. And I think, it's interesting when you look at a relative strength vis-a-vis the S&P, at least half of those, 6 of those sectors probably tell a much different story than you would have thought if you had just asked and what they were doing off the top of your head. So thank you for that. And we will allow you to get on with your day. So thanks, Dubs.
Thanks,
right,
Carter.
Bye, guys. Yep.
That was some serious heavy lifting on Carter's part. We appreciate that. Sometimes a really good guy to just take a look at sort of the internals of the S&P. We talk about it a whole heck of a lot. Let's take a hard turn right here. And we talked about some of the interest rate sensitive names, and obviously the dollar is kind of wrapped into that. Let's take a look at the dollar. Last week, we thought that we could get a little bit of a bounce. We're getting that a little bit, Guy, on a near-term basis. But I want to bring it out to a 4-year chart, because this would be something that's interesting to opine on. You see that 150-day that's kind of flatlining in the Dixie. That's the U.S. dollar index, about 104. We got to about 106 before we failed. And maybe this looks like a bit of a support, Guy, over the last 2 years or so. So thoughts on the dollar? Is it, to you, do you have to have a view on interest rates to have a view on the dollar right here? Because obviously, the 10 years come in pretty hard, and that obviously has caused the dollar to sell off, $5 or so. The U.S.
Yeah. Well, I think to a certain extent, you always have to have a view on interest rates. But last week when we talked about this, and this is actually one that we got right, we thought that the setup into Friday, the way the dollar, if you go back to that prior chart, Amanda, the way we traded down to that prior low and seemingly starting to bounce. I mean, you could draw a horizontal line from those lows from the beginning, late last year, the beginning of this year, and obviously where we just traded down to. And what I thought would happen, and sometimes you can be right for the wrong reasons, but I thought the dollar would bounce on what was going to be a pretty hot number in terms of the inflation data that came out. And again, we can quibble as to whether or not that was the case, but the reality is, regardless of whether or not that was a catalyst, the dollar has bounced. So what we thought would happen happened, maybe for different reasons. But the question now is this going to continue, or is this just sort of a short-lived bounce? I still think there might be some room to the upside here. I still think there's some jockeying going around. Dollar yen is a dollar yen story specifically. It does not necessarily play into this narrative, although you can't just take it for granted and put it on the back burner. But looking at this, I think this suggests to me there's still some room on the upside in the dollar vis-a-vis the other currencies in this, predominantly, obviously, the euro.
Yeah, what's interesting to me, guys, so we have the all important, August jobs report Friday morning at 8:30, and let's just say that number runs a little hot. Okay, let's say it's better than expected, right? And we know that August, one of the things that got, the sell-off going is just kind of a weaker sort of jobs market, right? So I think about rates coming in. I think about some of the data that we've seen, at least as it relates to consumer and consumer confidence. That's okay. And then the last thing I'll just say, with rates down, right, and then crude oil down, it's gone from 80 to about 70 over the last month and a half or so. You'd say that those are sort of tailwinds for a U.S. consumer, right? And so let's look at the one-year chart on the crude oil. It's getting back towards those levels where it bottomed out over the last month and a half. You see that kind of prior low going back to late 2023. And then on a 5-year chart, you see this downtrend. It's making a little bit of a pennant. You see where that support is. It's just a bit lower than these current levels. It's somewhere in the mid 60s or so. How are you thinking about crude oil? Because this is one we've also, kind of gotten pretty good. Last time it was down at these levels, we thought we'd get above 80. We got to 80. Then we kind of pulled the ripcord on this. We thought we'd get back towards, the low 70s. And maybe it's just some of the manufacturing data and the weakness in China and fears of global growth away from the U.S. consumer, and I'll just say this lastly before you get in here, if 2/3 of our GDP comes from a U.S. consumer and the mid to high end is still doing okay, and then these end up being somewhat of tailwinds, you say to yourself, maybe the consumer can hang in just a bit longer, Guy.
Yes, I understand. Well, the first thing people look at is energy prices, and historically that's been the case. But if you think about it, if you go back and look this longer term chart, I mean, energy's basically been sideways now for the better part of a year and a half. You've had some moves to the upside, moves to the downside, but it really isn't energy that's been driving things. I mean, the other components that have been killing people are non-energy related, specifically insurance and some of those other things. So it's not look, if anything, it's not a headwind anymore, but I wouldn't necessarily call it a tailwind. And so if we're trying to draw the parallels between energy prices and consumer, all I need to do is look at what Dollar Gen recently said and say, you know what, there's obviously something amiss here. In terms of the commodity itself, though, yeah, you're right. It trades horribly without question. And every rally has been sold off. Geopolitical risk is clearly being sort of overridden by not necessarily supply demand, but the slowdown in China, and obviously the slowdown that we're starting to see here, not necessarily in the form of GDP, but in the form of some of this manufacturing data. So the cross currents continue to be huge in terms of the underlying commodity. But with that said, this downtrend now been packed for 2 years is still in play. And inevitably, it looks like we're going to test that support, which probably comes in just north of $60 or thereabouts.
Yeah, and to your point about global growth and China demand, I mean, copper is kind of very, very interesting to me. I know you've highlighted, the weakness over the last few months or so. Let's look at a 1 year. You see that here, it got rejected at its 150, Guy. And let's just go to a 4-year chart of this because it's also sitting on a really interesting uptrend. So thoughts on copper and how important it is to that narrative about global growth in general?
I thought it was back on its horse last week. I said as much, I think, on our show, and I got to tell you something. It looked like a genius call at the time, and look how quickly. I mean, you see the chart that's in front of you. I mean, put the shorter term one up, and it tells a much better picture. Look how quickly we've given 2/3 of it back effectively. So I think that speaks to some of the things that we just talked about in terms of energy. And I also think, as Carter mentioned, I think Goldman Sachs might have had a note on about copper as well, which if you go to the next chart, Freeport-McMoRan, it's going to look hauntingly similar to what we're seeing in the underlying commodity. Again, that looked like a champion, and I thought the turn was in, only to have it sort of rebuffed. And here we have created this little bit of an island to the downside. So it looks as though the lows that we saw on that August 5th date, whatever that was, I think it was 37.5 or 38, Amanda can find it exactly. I mean, that feels as though that's in play for FCX.
Yeah, so let's look at the XME, that's the metals and mining ETF. And what's interesting, we just talked about the construction of some of those other, X sort of sector ETFs and how poor they are. This one's kind of interesting. The top 10 holdings on average, guy, are about 5% or so. The largest holding is about 6.5%, followed by Newmont Mining about 6%, and the rest are about 4.5 to 5%. When you look at this, it's the same chart. I just wanted to kind of highlight that a little bit. Two things left. Okay, guys, we got to hit the semis, and then let's kind of take a focus on JPMorgan and the trade that I have using the options. So let's just get your quick takeaway. The 3-day action in NVIDIA, you kind of hit it before a little bit. We were probably 125 heading into the print. I drew a few lines here. Okay, you see the downtrend. You also see the breakout level from May, which is also that gap around earnings. You see that August 5th reversal, right? So it gapped down, kept on going, reversed, closed on the high. And that was about 35%, guy, from the peak to its trough. You see it bounced off that 150-day. It's rising still. But today's price action, really curious. I think at one point it's down 8%. I think as we're talking right now, well, it's down nearly 8% or so. So thoughts on semis?
Well, I mean, you addressed it as well. I mean, the execution risk now, I think, is out there for people to evaluate. I also think that the concern about, and I talked about it, you've talked about it, at some point you will see a turn here in the form of, growth slowing, the magnitude of the beat slowing down in percentage terms, which is what we've seen, and then the subsequent potential degradation in terms of margins, which you didn't see last quarter, but I also think is inevitable given the competition that will come regardless of the head start that NVIDIA has. Again, for emphasis, not an indictment on NVIDIA. I mean, this is just what happens in all sectors, specifically semiconductors, especially when you have that kind of lead in terms of margins. The industry is going to come after you, and at a certain point, it's not going to necessarily catch up, but it will make up ground, and I think to the detriment of the share price. And since June 20th, and we addressed it that day when you saw that bit of a reversal, that engulfing pattern, say what you want, but the stock has not traded particularly well. So August 5th was an outlier. The bounce was much more robust than I thought it would be. But I think we're starting to see what I thought we're going to start to see for quite some time. This trend line is fine. I think the moving average is probably where we sort of visit again, and we'll see what happens at that battle line.
Yeah, that's $100, the 150, guy. So I think that's pretty interesting. Throwing up the SMH again. Here's a ETF that is very heavily weighted towards two stocks. It's NVIDIA and Taiwan Semi. Those two names are very much kind of connected to each other. If 85% market share is NVIDIA as it relates to high-end GPUs, that's about the market share that Taiwan Semi has in making them. All right, really quickly, guy, before we get out of here, bank stocks. And so today, I see Bank of America and Wells up a little bit. I see JPMorgan down 1.3%. That stock, let's just pull up the chart. I mean, I don't want to get your take on this, because this is one of the reasons why I'm being kind of drawn to this trade idea a little bit. Look at the way this stock has rallied from the August 5th low, massively outperforming the S&P 500, had that big reversal right near that 150-day moving average. Again, thank you, Carter, for kind of getting us off the 200-day towards the 150. You see the breakout, and you see the way it's broken out just in little bits and bobs. You know what I mean? When you think about it. So thoughts on this chart before I get into some of the reasons why?
I think what we're seeing here is, as people get more and more concerned about the underlying environment or the macro environment, they will find safety in certain places. And I think in terms of banks, they're going to find it in the bank they think is bulletproof in terms of all different things: management, balance sheet, businesses, resiliency, all those different things that get thrown into the mix. So when you're seeing, again, weakness economically and weakness in certain sectors, I think what's happened with the JPMorgan, as somewhat counterintuitive as it might sound, because banks should not be immune from what's going on, is this perceived flight to quality. And that's what you're seeing before your eyes. Unfortunately, or fortunately if you're long, but unfortunately it's done so on the back of a valuation that continues to get stretched. And in terms of JPMorgan, it's price to book and price to tangible book, which is something that Jamie Dimon addressed a couple months ago. I think it was midsummer or so, when he came out and said, and I don't know what prompted it, but he addressed his stock being expensive, and they talked about not buying back stock at those levels. So that's the way I look at this. It doesn't necessarily make sense, although in retrospect, given what's going on, it probably makes a lot of sense.
Yeah. And so my thought, just to your point, is that I think it's a very crowded trade for safety sort of reasons. The outperformance relative to the sector and relative to the S&P is interesting to me. The last thing I'll just say on this is that implied volatility, the price of options, is really cheap. And so I think in a market that might be, ready to kind of have another 5% sell off from here, I think that this is a pretty decent way to play, a market leader that's really, I think, very concentrated. So I want to use options. I want to look to September expiration. That would be September 20th. And so when I think about, playing for a move lower, I think that, there's probably decent support between 200 and 205. I want to use a put spread. I'm looking at the September 220, 205 put spread. It costs you about $2.50. That's versus the stock at about 222. It's a little higher right now. So I'm buying to open one of the September 220s about $3. I'm selling one of the 205s at 50 cents. So again, it cost me $2.50. I break even down at 217.5. I have a max gain of 12.5 at 205. Loss up to 250 between 217.5 and 220 with a max loss above. Here's the rationale for this trade. When I think about it, it risks about 1% of the stock price. It breaks even down about 2%. That speaks to what I think is the cheapness in the options. We just looked at the implied volatility. I have a max gain of about 6% if the stock's 205 or lower on September expiration. And like all long premium directional trades, I want to use a mental stop of about 50% of the premium that I'm paying. So if this options trade is worth about $1.25 because the stock goes sideways or goes higher, I'm going to look to cut this position at 50% of the premium. The last thing you want to do is litter your trading book with a bunch of trades that are going to zero. So I want to use that to risk management. And then on the flip side, if the stock does go lower and this 1 or 250 that I paid is worth $5, I'm going to look to take half off and kind of move on and play with the house's money a little bit. So that's how I'm playing JPMorgan using options directionally over the next few weeks.
And throw that catalyst screen up that Amanda made just real quick so people can see it. But I'll say this as well. 3.5 to 1 risk reward ish, back of the envelope math. And you probably, the probability in this trade is probably approaching, 37, 38% of the success. So I don't have that in front of me, but that's just a guesstimate. So I like this, especially given the backdrop of what we just talked about for the last 35 minutes. So again, the setup, you're taking advantage of the strength in this name over the last, since August 5th or so. And I think you're doing it correctly in terms of the duration and in terms of where you're selling the sell side of this put for sure.
Yeah. And just lastly, I'll just say this. So you just kind of estimated, what the delta is. And so what a delta is of an option is like for every dollar move, how much that option's going to move. And so right now that 217.5, that's the break even, is about a 30 delta. And then the 220 is about a 38 delta. So Guy, you were right in the middle there. So good on you. We covered a lot of ground here, Guy, and, interesting day in the markets. We're going to be back tomorrow at 1 p.m. Eastern. I think Liz Young-Thomas, the head strategist at SoFi, is going to be with us. We can't do the EY from SoFi. It's such a bummer, but
bums me out. But look, she wanted to get married, so I got to figure something else out. So good on her. Yeah. By the way, for you Met fans out there, very quietly, you've crawled yourselves back into this wild card race. Good on you, as they say, taking advantage of the White Sox. But listen, you beat Arizona as well. So Mets are in the hunt here. Yankees righted the ship last night, but for those that were keen in watching the game, you will notice that two kids that basically grew up together in New York City and then in New Jersey faced off against one another last night, I believe in the third inning, when Anthony Volpe against Jack Leiter. They are best friends. It's a really cool story. They went to high school together. And I'm not dropping names, but I've known both these kids since like 12 years old because they went to school with my son. So there you go, Dan.
That's pretty cool. Yeah, good weekend for the Yankees and the Mets. I hate to say it to you, Guy. All right, let's get out of here, man. It was a lot of fun. Thanks to Carter Braxton Worth of Worth Charting. Thanks to Guy Diamond. Thanks to the viewers for being here. We appreciate you guys. We appreciate the support. So we'll see you all tomorrow, 1 o'clock.